Okay. Good morning, everyone. Good morning. I think some are joining, some have joined. Mamta is there, Niranjan, Stephen, Kishore. Okay, fine. So let us start with Ind AS 102 that deals with share-based payment. Okay. Uh, how many of you know that there was a guidance note on this? Does anybody know or recollect this matter in your CA intermediate? Okay. So there was a guidance note earlier in this respect that was titled as Guidance Note on Employees Share-Based Payments. Okay. Now, it was a guidance note that was formulated by the institute, and many of the entities that provided your stock options, they would do the accounting in tune with that guidance note. Now, under the Ind AS regime, there is a separate standard altogether. The key point to note was the guidance note focused on only employees' share-based payments, whereas the standard focuses on share-based payments. That means the scope is very, very broad under the Ind AS regime. It focuses entirely on all the gamut of share-based payments, whether it is employee share-based payments, whether it is vendor share-based payments, whatever it is, it comes under the gamut of Ind AS 102. Okay. From your examination perspective, how important this topic is, it's extremely important. It is a hot favorite among your examiners. Okay. You typically can expect a question ranging from 6 to 8 marks coming in your final examination. Okay. It's almost a regular feature, and therefore we will have to uh, 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 be very serious about this particular standard. Good morning, Ankit. Good morning, Nancy. Good morning. So now, why is this so important? Is because there are a lot of computational aspects that you have in this particular standard. Okay, if you would have checked the Board of Studies portal, I have uploaded the presentation for today's and 14th session that is on share-based payments. And I have also uploaded in the assignment section the questions that we are going to discuss, which contains the solutions also. Clearly, this is a very huge standard. Okay. So I will be a little fast. Instead of making us to write down the notes in the traditional conventional manner, time does not permit it. So therefore, I have documented everything in this particular presentation, which we will now be discussing. I think that should be fine with everyone. Okay. Good morning, Gocha. Good morning. Good morning. Good morning, Hemant. Good morning, Anila. Good morning. Okay, all right. So with this background, we start off with the proper standard. So what are we going to do is, we will look at why do I need a separate standard? What is the meaning of certain defined terms, which is also there in, which is coming from Appendix A to the Ind AS. We will look at what is the scope that is covered under Ind AS and what is the recognition as per Ind AS 102. Equity settled share-based payment transactions, what do they mean? The principles of measurement and the transactions where you receive the services, certain miscellaneous aspects. Then we look at cash settled share-based payment transactions, SBPTs, and SBPTs with cash alternatives. And we wind up with SBPTs among group entities. So these are the four to five broad categories that we are going to discuss. Among this particular item, equity settled SBPTs from an employee perspective is something that we will focus a lot on. Okay. But this was also covered under the guidance note. This was also covered under the guidance note. So you will find a lot of parallels between what we study here and what has already been studied there. But Cash settled SBPTs, this was also there in your guidance note as far as employees based cash settled payments were concerned. SBPTs among group entities was not there. This is a fresh item. SBPTs with cash alternatives also is a fresh item under Ind AS 102. Extremely important. Okay. So with this agenda for the coverage, let us proceed further. So what is the objective of Ind AS 102? This is the first para of any standard that you open up. The objective, what does the Ind AS intend to achieve? So there is a parallel standard in the IFRS regime, IFRS 2. Okay. So what is the objective? It is to specify the financial reporting for an entity undertaking a share-based payment transaction. So we are in whose books? Are we in the entity providing the services and getting payments based on shares? Or are we in the books of the entity receiving the services and making the payment in the form of shares? Or based on share price? Whose books are we? So we are in the books of the entity which is receiving the services. Okay. We are in the books of the entity receiving the services, and we are making a payment that is based on the shares, share value, share price, or directly in the form of equity shares. Okay. So we are in that entity's books. So therefore, the objective is to specify the reporting for such transactions. Now, what is a share-based payment transaction? It is a payment that is based on price or value of shares. See, the standard is not saying payment only in equity shares. It's very important to note. Today, I may make payment in the form of cash, but that payment which I'm making is based on the share price of the entity. Are you able to follow? It's not a direct quid pro quo where I get a service worth 100 and I pay 100 rupees. No, I'm making the payment on the basis of movement in the share price, in the movement of my own share prices. Okay, again, it cannot be any XYZ share price. It has to be in my own share price, and therefore that also will be covered under Ind AS 102. So it's not restricted to payment in the form of equity shares. It could also be cash payments, which is dependent on the share price or the value of these shares. Is it okay? So what are the examples? Most common is employee stock options and payments to suppliers of goods or services. Okay. Since employee stock options has come, we are having another standard, Ind AS 19, that deals with employee benefits. Sir, but employee benefits, employee stock option is also an employee benefit. Yes. So when we study employee benefits in the scope out, that means what is out of the scope of Ind AS 19, they will tell employee share-based payments are outside the scope of Ind AS 19. Why? Because that is covered under Ind AS 102. Okay. So the next standard immediately is Ind AS 19. So there you can get this link. Okay. Ind AS 102 share-based payments. Parallel under the earlier regime, guidance note on accounting for employees share-based payments. Is it all clear so far? Yes. Very basic. Okay. So what is a share-based payment transaction? Receives goods or services from the supplier of those goods or services, which includes an employee. Does the employee provide services? Answer is yes. Does the employee also provide services? Yes. It is his part of the employment contract where he is expected to deliver certain services, and in return, payment will be made to him. So the entity receives the goods or services in a share-based payment arrangement. In a share-based payment arrangement. Or, and this or is very important because this is something which you have studied partially under the guidance note. This is the new one. This is the new one. Okay. Incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement. SBPA is a share-based payment arrangement when another group entity receives those goods or services. That also gets covered. Okay. So what are the examples? See, this example is fairly clear. I will not go into this in detail. But what is this one? Let us assume that I have employees of Tata Sons. Okay, I have employees of Tata Sons. Tata Sons employees are working for Tata Sons. They are providing services to Tata Sons. Tata Sons is an unlisted entity, and therefore, even if that company comes out with a share-based payment transaction where they say we will issue shares of Tata Sons, employees will say, what do I do with that? I cannot liquidate it. There is no market for that. I cannot get a buyer. So it is as good as you're giving me nothing. So Tata Sons tells, all right, you work for us, and as a compensation, we will offer you shares in our subsidiary Tata Consultancy Services, which is a listed entity, So services are provided in Tata Sons, but shares are coming from Tata Consultancy Services. So the group is receiving the services. One of the entities forming part of the group is receiving the services, but the payment in the form of shares is pertaining to another entity which is forming part of the same group. So that becomes a group share-based payment arrangement. And how to do the accounting is something that we are going to review under this particular standard. Are we okay with this? Yes. Everyone, are we okay? Stephen, Nisha, Niranjan, Karthik, Hemant, Kishore, Anila, Pocha, all clear? Nancy, Ankit, so far all clear? Okay, fine. Next. All right. This is a further elaboration of that definition. So in a share-based payment arrangement, what do you mean by share? This was share-based payment transaction. This is a share-based payment arrangements. We have two parties, party one and party two. Party one could be the entity itself receiving the services, or it could be another group entity, or it could be any shareholder of any group entity. The counterparty could be any other party, that is an employee or a supplier of PPE or even material. Okay, this is just an example. It could be material, property, plant, equipment, anything. Okay, by virtue of the agreement, provided specified vesting conditions are met, this counterparty is entitled to receive cash or other assets of the entity for amounts based on price or value of the equity instruments of the entity or another group entity, or entitled to receive directly the equity instruments. Here it is cash or other assets. Here it is equity instruments, which could be shares or share options of the entity or other group entity. So this constitutes a share-based payment arrangement. Okay. So are we aligned on this definition? SBPT, SBPM. Theoretical in nature, it has no, it will not be asked in the examination, but nonetheless, it's something that we are going to use on a regular basis in the next two sessions. Okay. So I leave these questions to you for homework. That is just for our understanding. Okay. Like what is a share-based payment arrangement? What is a share-based payment transactions? You can go through these questions from the study material for your own reference. These are just examples that the institute has given. There are plethora of examples which are there in the study module. Yes, Mamta, please tell me. Bataiye.
So in definition share-based payment, please go on previous slide.
Anji, yes, 1 minute. This one?
Yes, sir.
Okay.
Sir, party one, in case of another group entity, I
Anji.
have not understood. That is not relevant to another group, means that is not related to me or
No, no. When we say another group entity, like for example, I explained Tata Sons is a group entity, correct? Services are provided by the employees of Tata Sons to this company. Okay. But payment is received in the form of TCS shares. Is it okay? So one group entity is receiving the services. but another group entity is making the payment. That is why this particular clause is there. Is it okay?
Okay, sir.
Yes. So that is how. So this is a new thing that is there in the standard. This was not there under the previous. This was not there under the previous guidance note. Previous guidance note was very simple. Where you work, payment is coming there. Very simple. But under the revised one, where are you working? You can also receive the payment from other entities forming part of the same group. Okay. So that is done. I leave this example, certain examples for your homework. Please go through them. They will not be coming in your exam for sure because it's theoretical in nature. But for your clarity, for giving you better insights, this is going to be very, very helpful. Okay. So you can go through all these. I have put them all related to the manner how we are dealing with the chapter. So I have just accumulated them at one place and kept for you. Okay. So all these you can go through it. This also you can handle. I hope you have received this. Okay. Now, the question was in the share-based payment arrangement, we saw party one that dealt with the entity or the group entity. Party two was the counterparty. So the definition comes, who is a counterparty? Who is a counterparty? Counterparty could mean it is divided into two categories. One is employees and others providing similar services. Second is parties other than employees and those providing similar services. Can somebody tell me who comes under the category of others providing similar services? Yes, one is employees. But who could be other than employees providing similar services?
Freelancer, sir.
That's right. Contract employees, Hemant has mentioned contract employees. So in the contract employees, basically, I am not hiring the manpower on my payrolls, but I engage a manpower services supplier to give me the relevant manpower. Okay. It's what you call as casual labor who are not on the payroll. Now, these employees are not strictly on my payroll, but they provide me the services in the form of an employee. So they are also covered under this. And you have parties other than employees. It could be your vendors, vendors of capital equipment, vendors of material. All of them will be covered here. Now, why do we have a different? Categorization for this counterparty? Why is it so important? Reason is the measurement date is considered differently for these two categories of counterparties. See, when you're having an employee share-based payment arrangement where employees are providing services to you, the measurement date will be the grant date. We will look at these terms later. Okay. The measurement date is the grant date. But when you have other than employees, it becomes the date when you are in receipt of the goods or services. We will be looking at that. Okay. So other employees providing similar services, this is the definition. I mean, who is covered in that? Individuals who provide personal services to the entity, and either the individuals regarded as employees for legal or tax purposes, or they work for the entity under its direction. So this could be your contract labor, or the services are similar to those rendered by employees. Okay. Includes all management personnel as well as non-executive directors. Okay. So this is the meaning of others. Okay. All right. Now we come to West. What is the meaning of West? Okay, we are now slowly moving into share-based payment arrangements nitty-gritties. Okay, what happens? What is the meaning of these terms? Because once I know these terms, then I will be in a position to understand the questions better. So West means, suppose an employee has been working in an organization and the entity wishes to give him equity shares in the entity for the services that he has been giving. It's a common feature in today's times where you have even well-established companies giving a certain percentage of the compensation in the form of employee stock options. So today I join, I will not become entitled to share-based payments probably today itself, because I need to work and prove my worth to the organization. I need to prove that I am a valuable asset to the organization. So this period where the employee is required to work so that he becomes entitled to the options. So that act of the options getting entitled to the employee is known as vest. Okay. So suppose an employee's worth can be judged in 2 years. So then they will say that, okay, after 2 years, these options will vest. So you become entitled to those options after a period of 2 years. And that 2 years is called a vesting period. Those 2 years of time limit is known as vesting period. So vest means, suppose I leave the organization before the options vest. That means I'm not entitled to the options. So when I retire or when I resign, I will not be getting those employees stock options. Okay. So under a share-based payment arrangement, a counterparty in our example could mean employee. In our example could mean employee. Right to receive cash, other assets, or equity instruments of the entity vests when the counterparty's entitlement is no longer conditional on the satisfaction of any vesting conditions. That means he owns this asset, he owns these equity shares, he is entitled to get it. It's not yet come to him. There is probably an activity that needs to be done in the exercise period, but now he already has the right over the employee stock options that have vested in him. He has fulfilled all the conditions that are outlined for the options to vest in him. Now, no further condition is there. So the options vesting or the entitlement to those options is no longer conditional on satisfaction of any vesting conditions. That means the vesting conditions are fulfilled by the counterparty. So that is the meaning of vest. And what is the vesting period? The period in which all the specified vesting conditions are to be satisfied. So there could be certain vesting conditions like an employee is expected to serve the organization for a period of 3 years. This becomes a vesting condition. So therefore, the vesting period is 3 years. He is expected to remain employed for a period of 3 years. And therefore, that 3 years is a vesting period. And the condition is he should continue to remain in employment, means he cannot resign in those 3-year period. Are we okay with this? Yes, vest and vesting period. Yes, any doubts? No doubts? Ankit, Nancy, all clear? Yes, all right. Okay, fine. Have you heard these terms before? Or is it the first time? Have you worked out on these terms before? Yes, you have heard it in ESOPs. All right, fine. Then that's enough. That's enough. Okay. All right, fine. So after the vesting period is done, there comes the exercise period. There comes the exercise period. What do you mean by exercise period? Exercise period is the period when the options which are vested can be exercised and shares can be purchased. Okay. Suppose an employee resigns. Suppose an employee resigns in the exercise period. Will he be entitled to options? Answer is yes. He will be entitled to options. Why, sir? वो तो छोड़ के चला गया ना. हाँ, but when did he leave? He left after fulfilling all the conditions. After the options have vested in him. After he has become entitled to these options, after he has gotten a right over those options, after he has fulfilled all the vesting conditions, after ensuring that those options are no longer conditional on fulfillment of any vesting conditions. After fulfilling all these items, he has resigned. So he becomes entitled to that particular vesting, to those particular vested options, even if he resigns during the exercise period. Okay. Granting will happen depending on what are the terms of the contract. Okay, so after 3 years, probably they will say you have a 2-year time period to exercise. So when you exercise, the options will be granted. When you exercise, the options will be granted to you. Okay. And in the context of employee stock options, there will be a separate item known as a grant date. So those grant dates and all, we are going to have a look at it shortly. Okay. Fair value, very important. Very, very important. Okay. You can forget anything in this chapter, but not fair value. Okay. What is the fair value? It is the value of the option. It's not the difference between the market price and the exercise price. That was something you used to do in ESOPs, which is known as intrinsic value. Intrinsic value is not there now. Okay. Definition is there, but the application of intrinsic value is no longer existent. Now it's only and only and only fair value. So what is the fair value? It is the value of the option which is calculated using an option pricing model, like the binomial model or the Black and Scholes model, if traded options with similar terms do not exist. So if similar options exist, we can take that. Otherwise, we will have to do an option valuation using Black, Scholes or binomial or any other method. Okay. Or any other method. All option pricing models take into account at least 6 things. One is exercise price of the option. Second is life of the option. Third is current price of the underlying shares, volatility of the share price, dividends expected on shares, and risk-free interest rate for the life of the option. This is just for our understanding, but you may be studying this in detail, option pricing, when you are studying your financial management. I think you have a paper called Advanced Financial Management or Strategic Financial Management, right? So in that, you do have options. In options, you have option pricing. So there you will be studying this. Okay, there you will be studying this. Is it okay? Where is 180? Okay, where is, I don't know, what is your question, Ankit? Yes, how 180 has come. Where is 180? I also don't know. Okay, all right, fine. So my point is valuation and accounting will be done only on the basis of fair value. It's not on the basis of intrinsic value. Okay, okay. Next one. Vesting conditions. There are certain conditions that need to be fulfilled for the options to vest in the employees. There are certain conditions to be fulfilled for the options to vest, to receive, that enables the counterparty to receive cash, etc., equity instruments, etc., under a share-based payment arrangement. So types of vesting conditions are classified broadly into two. One is a service condition where you are only expected to be continuously employed, and one is a performance condition. So what is a service condition? Just be employed. आप काम मत करो, but be employed. Okay. In very layman language. Okay. Obviously, you will be expected to work, but my point is service condition requires you to remain employed with the organization. Targets are not required, not given to you. कुछ भी नहीं दिया है. Just your presence as an employee is enough. Performance conditions means you are required to fulfill certain targets. You are required to achieve certain targets. So that is broadly classified into non-market condition as well as a market condition. Non-market as well as a market condition. So we have two things. Non-market condition means a condition that is not dependent on the market price of the shares. Market condition means it is having a bearing on the market price. So condition not satisfying above becomes a non-vesting condition. There could be certain non-vesting conditions also. Example, target based on a commodity index or continuation of the plan by the entity. Okay. So when I talk about vesting conditions, I have already given the explanation to service condition and performance condition. Service condition requires the counterparty to complete a specified period of service. If counterparty ceases to provide the service for whatever reason, then it has failed to satisfy the condition. Service condition does not require a performance condition, a performance target to be met. Are we okay? So this is one. Second is, what is a performance condition? The counterparty to complete, it requires the counterparty to complete specified period of service and specified performance targets to be met. So two things are there. There is a service requirement, and in that service requirement, he has to meet the performance targets. So performance condition is a cumulative sum of service condition with achievement of performance targets. Okay, these are the two things. Okay, all right. This is again going into that definition. You can go through this for homework. You can go through this for homework. Okay, all right. When I talk about performance conditions, there are two types. One is a market-based performance condition, and the other is a non-market performance condition. Non-market performance condition, for example, I want to increase my sales by 10% year on year. That is one of the non-market based condition. Or I need to drive a cost reduction in respect of my traveling costs within the organization. So that becomes a second non-market condition. Okay. Non-market related conditions do not have any impact on market price of the shares of the entity issuing such share-based payments. Is it okay? Yes. It is linked to some internal performance or operations or activities of the entity. It is linked to the internal operations or activities. When I talk about market condition, it is a performance condition upon which the exercise price, vesting or exercisability of an equity instrument depends upon market price or value of entity's equity instruments or equity instruments of another entity in the same group. Are we okay with this? Yes. Are we okay with this? Yes. I think Ankit and Mahalakshmi, you are posting your queries in the right field. It looks like these are intermediate students who are. Okay, fine. All right, let them attend there. Okay. All right. Okay. Fine. So non-market related conditions do not have any impact. Okay. When I talk about, okay, I have two questions. Hemant has asked, give an example of market condition. Okay. So market condition could be very simple, like, okay. So suppose the market price of the share is 1300. You will say that the options will vest in you if the market price reaches 2000. So that could be one of the performance conditions, which is a market condition. Now you will come with immediate queries. Sir, but market price, how can the employee influence it? That is influenced by market conditions. Exactly my point. So how to do the accounting of a market-based performance condition differs from how to do the accounting of a non-market-based performance condition. Okay? So that is the meaning of a market-based condition, market-based performance condition. Okay. Please give again the example of non-market conditions Jeannie has asked. So non-market based performance condition could be something like example, increase in year on year sales by 15%. My sales I want to increase by 15%. Increase in year on year EBITDA by 20%. Are these related to market price? Answer is no. These are related to my operations. If I want to increase my EBITDA, that is a decision that is the what you can say, that is something that the organization's operations team should also work on. Okay, they can either drive more revenue, or they can focus on improving the margins, or they can focus on making high margin sales. Okay, or they can focus on a cost control. So all these are activities which do not have a bearing on the market price. The market price does not influence these activities. So it's independent of that. Or you could take cost reduction for indirect expenses by 10%. So all these market price or market conditions have no bearing. These I can do even without any dependency on the market. And therefore, these become your non-market based performance condition. Are you clear, Jeannie? Yes. Okay. Hemant, are you okay with the example of market-based performance conditions? Yes. Increase in share price. Yes. All right. How to account for it? I have not even come there. Okay. So we will look at that later. Okay. All right. Non-market condition versus market condition. This you can go through this for homework. It's just what I have told you. Or kuch bhi nahi hai. Okay. All right. Okay. So this is a useful chart that you can have. I think this is picked up from your study material itself. So the condition determines if the entity receives the services against the share-based payments. So condition requires you, does the condition require you to receive any services? If the answer is no, it becomes a non-vesting condition. We'll look at the examples. If the answer is yes, then does the condition require only specified period of service to be completed without any performance targets? Only completion of the period of service. If that is the case, then it becomes a service condition. If it is not the case, it is not required to only complete the service, you have to also complete certain targets, then that becomes a performance condition. And in those performance targets, are they dependent or based on the share price of an entity or share price of a group entity? If the answer is yes, it becomes a market condition, else it becomes a non-market condition. Are we okay with this? Yes. Okay. So this is the broad categorization. So whenever you get a question on share-based payments, which is driven by some of these conditions, the first thing you have to do is identify what is the nature of the condition. Is it a market-based performance condition, non-market-based performance condition, or is it a service condition? Okay, this is the first thing that you need to do. Okay. All right. I leave this for homework. This also I can leave it for homework. Okay. Homework. Okay. Just go through these examples. Each example won't even take half a minute. Okay. Go through these for homework. Homework. Okay. All right. Okay. That is something you can go through. Okay. Now coming to the grant date, I need you to remember these particular definitions. See, it's all very simple what I have discussed till now. It's nothing that is very difficult or technical. Okay. But I need you to remember some particular definitions because they have a direct bearing on our accounting. Market-based, non-market-based performance conditions. Very important. Service condition, so you are already very comfortable with that. Then you have the grant date. Very important. The date at which the entity and another party, that means the counterparty, party two in the share-based payment arrangement, the date at which the entity and the counterparty agree to a share-based payment arrangement, being when the entity and the counterparty have a shared understanding of the terms and conditions of the arrangement. That means on this particular day, both the entity and the counterparty, the entity making the payment, the counterparty rendering the service, they have a common understanding. They have a shared understanding of the terms and conditions. Grant date occurs only on agreement. That is, when I say an agreement, offer by the entity and acceptance by the counterparty. How many of you have studied contract law? How many of you have studied Contract Act 1872? No, it is something like that, I think. Not sure. You have studied in your foundation Contract Act. So Contract Act में, what are you looking at? Is only an offer adequate for it to become a contract? Answer is no. Offer followed by an acceptance makes it a contract. Offer followed by acceptance makes it a contract. So here also, grant date occurs only on agreement. But the acceptance can be explicit or implicit. The acceptance could be explicit or implicit. If that agreement is subject to an approval process, for example, by shareholders, then the grant date will be the date when the approval is obtained. See, when you give your, what you call, when you give your uh, stock options to employees, obviously existing shareholders' stake in the company will come down. So the organization must take their approval first, because they are getting adversely affected by virtue of the employee stock options. And therefore, if you require their approval, then the date when they give the approval will become the grant date. उसके पहले you may have agreed, but approval आएगा ही नहीं, तो फिर अब कहाँ का एग्रीमेंट हो गया, है ना? वो एग्रीमेंट होगा ही नहीं, बिकॉज शेयरहोल्डर्स ने अभी तक अप्रूव किया ही नहीं. So when shareholders approve, that will be the date, that will be your grant date. Now, why is it so important? Why is grant date so crucial? At grant date, the entity confers, that means it gives the right to cash, assets, equity instruments, etc., provided specified vesting conditions, if any, are met. So the grant date is, I am giving you the right, provided you fulfill my conditions. So that is effectively the meaning of grant date. Are we okay with this? Yes. Yes. All right. Okay, you can go through these examples. Okay. Okay. ठीक है. Shall we proceed further? All guys, Pooja, Nisha, Niranjan, Monica, Mamta,
Yes, sir.
or here? Okay. All right. Okay. ठीक है. Okay. All right. So that covers your definitions of grant date also. Coming to measurement date. Now, this is the next important part. What do you mean by measurement date? The date at which the fair value of the equity instruments granted is measured for the purposes of Ind AS 102. See, what are we doing? What are we doing? We are basic. I'll come to your query, Hemant. Okay. We are essentially required to account. Account के लिए क्या चाहिए sir? I need numbers. I need figures. I cannot just account a contract unless there is some money terms involved. So I need a measurement. I need something that can be measured. So in all these cases, So many things are there. Grant date is there, vesting conditions are there, performance conditions are there, market conditions, non-market based conditions, approval is required. So when do I actually do the measurement? So for that period, there is a definition of measurement date, which says that the measurement date for transactions with employees is the grant date, is the grant date. But when I look at parties other than employees, the measurement date is the date on which the entity obtains the goods or counterparty renders the services. Okay? So there are two different measurement dates. That is why when we saw the definition of counterparty, it's categorized into employees other than employees. Why? Because measurement date is different for employees, different for other than employees. Now I have a query from Hemant, which is that what is the difference between grant date and vesting date? What is the difference between grant date and vesting one day? What is the difference between grant date and vesting date? Okay. So if I have to put it in a timeline form, if I have to put it in a timeline form for you, on this date, on this date, the company announced that it intends to give stock option. So here there is the announcement that is made. But the announcement is just an announcement. It says that we intend to give stock options to the employees. Abhi tak there is no consensus, no formal agreement has come in, there is no agreement to the terms of the contract. This is just an announcement. After the announcement, it comes to a discussion and an agreement. Okay, you come to an agreement, but this agreement gets fulfilled only when you get the approval from the shareholders. So here you obtain the approval, you have agreed, and therefore this becomes your grant date. This becomes your grant date. Let us give certain dates to this. This is, let us say, 30th June. Agreement has happened on 31st July and approval is received on 30th of September. So the grant date is 30th of September. Now, as per the contract, you are required to provide continuous service for a period of 2 years. Okay, so if this is year one, then for 2 continuous years, you need to provide the service. So 30th September, year three. On this date, you have fulfilled the service condition. So this is the date when the options vest in you. So this becomes your vesting date. Because on this date, you have fulfilled the vesting condition, that is the service period, and there is no other condition pending. So your options have vested on 30th June, 30th September at the end of the third year, 30th September, year three. And then you are having one more year to exercise. So 30th September, year four. This becomes your exercise period. This becomes your exercise period. So to answer Hemant's question, 30th September is the grant date, year one. 30th September, year three, you have fulfilled the conditions. This becomes the vesting date. And the exercise period is 1 year from the end of the vesting date. Are we okay with this? Hemant, did you understand? Yes. Okay. All right. Others, Jeannie, did you follow? Stephen, Nisha, Anila, Devraj, Pooja, Kar, all clear? Okay. Fine. Fine. Okay. Fine. So that is his query. So measurement date. You can go through this RTP question for homework. It's just on what is the identify the grant date and the measurement date. Okay. All right. Now, what is covered under Ind AS 102? What is covered under Ind AS 102? Equity settled share-based payments, cash settled share-based payments, where you have an obligation to deliver cash based on the movement in your share prices, or share-based payments with cash alternatives, which is a compound instrument. Okay. All right. What is excluded? Certain group share-based payment transactions. You can go through the theory. Transactions with equity holders themselves. Okay. So I have certain equity holders. I make a rights issue and they subscribe to it. Will it be covered under share-based payment? Answer is no. Because in this case, they are not performing any service. They are not performing any service. They are providers of capital. So therefore, transactions with equity holders is not covered under Ind AS 102. Transaction covered by other Ind AS specifically will be dealt with as per those Ind AS. So para 3, 4, 5 and 6 is where you are having these particular exclusions. Okay. All right. Go through these examples for what is covered, what is not covered. Because here, no much value that I see for the discussion, given that the standard is huge. Okay. All right. Recognition of share-based payment transactions. What is the journal entry? Well, you debit the asset or expenses, credit equity or liability. Fine. We'll do one thing. We have all this data available with me now. We have all the definitions completed. Let us now move on to do certain questions. With the questions, we can cover more and more theory because सुबह से खाली theory चल रहा है. Almost 1 hour I have been speaking. And then beyond some point of time, we are not going to understand. We are not going to understand the standard because it becomes only a theoretical explanation that is being delivered. So what we are going to do is we will look at certain questions. And once we do those questions, we will come back to the theory. That time, the definitions you only will be able to explain to me. You alone will be able to explain to me. I don't have to do anything. Okay. So with this background, is it okay? I think the approach is fine. Major definitions we have all covered. Yes. Shall we look at the questions?
Yes, sir.
All right. Fine. So from examination perspective also, it becomes important. Okay. All right. Good Luck Limited grants 180 share options to each of its 690 employees. Each grant containing condition on the employees working for Good Luck over the next 4 years. Okay, you tell me now, what is the nature of this condition?
Service.
Service condition. That's right, Anila. Service condition. Okay. Not related to any performance target. Right, Karthik? Okay. Good Luck Limited has estimated that the fair value of the option is 15. Good Luck also estimated that 30% of the employees will leave during the 4-year period and hence they will forfeit their rights to the share options. If the above expectations are correct, what amount of expenses should be recognized during the vesting period? Okay. Okay. So let us come to this. This is the same thing. I have just put it in a question answer format. I have given reference to the slide numbers also so that you can cross reference and do your do the revision. Okay. So I would love to solve this physically with you, but we don't have the luxury of time. Okay. So how many employees? 690 employees. How many options? 180 options. So 690 into 180, 1,24,200 options are there. How many employees expected to leave? Sir, 30% expected to leave. And therefore, in the service period tenure of 4 years. During the service period tenure of 4 years. If 30% are expected to leave, how much is expected to vest? Only 70%. So 1,24,200 into 70% gives you 86,940. Options or shares जो बोलना है बोलो. Okay. Fair value per option is 15, and therefore the total fair value of the options is 13,04,100. Are we okay with this? And since it is for 4 years, I will be dividing it by the vesting period of 4. So each year we are expecting 3,26,025 to vest. To vest, that will be my expense, annual expense. Are we okay with this? Clear? Yes. Anybody? Any doubts? Monica, Karthik, Hemant, Niranjan,
No, sir.
Kishore, all clear. Okay, fine. Fine. Just give me a minute. All right. Yeah. So that takes care of the first point. Okay. Now an observation. Okay. Now an observation. Why are we reducing this 30%? Can anybody tell me?
To calculate actual number of employees that are going to complete that vesting period condition.
But ये estimate है or is it actual?
Estimate.
So can it be actually this is going to happen, or can there be a variation in this? 30% गए, only 25% went. Can it happen?
Yes, sir. Variations can happen.
Variations can happen. Absolutely right. Variations can happen. So, is this leading to a management bias in the financial statements, or rather, can this lead to management bias in the financial statements?
Sir.
Yes. Karthik has said. Pooja, can this lead to management bias? Anila?
No.
Yes, sir.
Yes. What is management bias? Her management क्या चाहता है? They want to show profits. So if they want to show profits, one is either you earn the profits or you color your books. So if you want to color your books, you do the what you say play around with these estimates. 30% क्यों? I will estimate 60% will leave. Then what? Then the expense that is getting hit in your P&L will be only 40%. Will be only 40%. Then what happens? Expense goes down, And anyways, when are you going to do a cumulative catch-up? At the end of 4th year, when actually the options vest. Us time pe I may not even be there. I may have resigned or I may have retired, whatever would have happened. Aaj ke din to I can color the profits in this way. Yes or no? Yeah.
Yes, sir.
And therefore, that's why we always say that when you're doing your Ind AS, see the major challenge with Ind AS is that it's realistic, okay, which is good, but it requires management to make estimates at every point of time, and it also requires auditors to audit those accounting estimates. See, this auditing of accounting estimates was there earlier also, but the importance or significance of that has risen tremendously because of the way the numbers are calculated on the basis of the way the numbers are calculated and presented in your financials. You need to present sound evidence for that. So in the case of 30% employees leaving, what can be the basis for this? Well, you can look at the past attrition rate trends, like what who mentioned here, Hemant
Sir,
mentioned. Yes,
sir,
yes,
there are some expert advice like actual advice.
that's right. That's right. Actuarial advisors. You can look at industry trends. Otherwise, you can look at each employee also. Each employee, if you look at, whether they are job hoppers, whether they're expected to leave every 2 to 3 years. So based on that, you can come at a reasonable estimate and give. At the end, it is an estimate. At the end, 30 may become 20 also, 30 may become 40% also. You will do a cumulative catch up later on. But today, when you are making the estimate, you are expected to make a prudent estimate. And being the auditors, if you're going into an assurance function, you are required to analyze whether that estimate is prudent or not. So in the case of the auditor, it's not just the arithmetical accuracy. In fact, this thing anybody can do. System दे दो वो खुद ही निकाल के दे देगा. Yes. So this is something that needs to be checked, but this is not the core of it. We have to go behind it and question how are you finalizing this 30%. Okay, that's just for your practical interest. Okay, all right, fine. So that takes care of this one. What amount of expenses are to be recognized during the vesting period? So this question is done. Okay, I hope this question is clear. Okay, all right. Let us move on to the next one. This is illustration 1 of your study material. Okay, page 7.72, 7.73, it's there. Okay, ABC Limited granted to its employees share options with a fair value of 5 lakhs on 1st April 20x0 if they remain in the organization up to 31st March 20x3. बोलो कौन सा condition है? Performance or service?
Service.
Service, sir.
Service condition. Absolutely. Karthik is also right. It's a service condition. कितने साल तक सर्विस करना है? X0, X1, X1, X2, X2, X3. For 3 years, they will have to render the services. They will have to render the services. Now, what is the grant date? 1st April 20x0. And what is the fair value of the options on the grant date? 5 lakhs. So this will become my measurement. This will become my measurement value. Now, in this question, कोई और value दिया ही नहीं है. There is no other numerical value given. That's why we know that 5 lakh. But in the case of even further questions where multiple values are given, you will always take fair value on the grant date as the measurement for the purposes of employees, for the purposes of share-based payments, employee share-based payments. Okay, all right. On 31st March X1, ABC expects 91% of employees to remain in employment. On 31st March X2, it expects only 89% to remain in employees. However, in the end, only 82% remained and all of them exercised their options. So pass the journal entries. Okay, all right. Is the question clear? So every year on year, the estimates are changing. Year on year, the estimates are changing. So let us look at that. So what normally you can do is you can prepare a table. You can prepare a table for the 3 years, X1, X2, X3. So percentage of employees expected to satisfy the condition is 91% in the first year. So value of options expected to vest is 5 lakh was for the entire 100%. So 91% of that will be 4,55,000. Now I'm expecting 91% of these employees to remain in service for 3 years. So this 4,55,000 is an expense for the next 3 years. Are we okay with this? Yes.
Yes, sir.
So 4,55,000 into 1 by 3. So annual expense is 1,51,667, the first year's expense. In year two, when you are closing, you estimate that, sir, mera number to 89% hi rahega. 2% extra will be my outgo of employees. So overall only 89% will remain. So 5 lakh into 89%, 4,45,000 into 2 by 3 because 2 years have passed. So at the end of second year, 2,96,667 should be the total cumulative expense. But out of that, you have already recognized 1,51,667. So you will book an expense of 1,45,000. Are we okay with this? Yes. Anila, Pooja, Monica, all clear? Mamta?
Yes, sir.
Okay. So that's fine. All right. And in the last year, only 82% it has vested. So that will be 4,10,000 minus what is recognized in year two. So 1,13,333 is your expense for the third year. So your expense for year 1, 2, and 3 is 1,51,000, 1,45,000, and 1,13,333. Okay. So coming to your journal entries. Now, this is something that you would have done it. Okay, you would have done it. So nothing very difficult. So employee benefit expense. This is a benefits for the employees. So employee benefits expense account debit to SBP reserve, to share-based payments reserve, 1,51,667. याद करके बताओ what you used to do in your guidance note in your intermediate. Where do you book this? Where did you book this? Share-based payment के बदले we use the different term there, stock options outstanding account. ठीक है, वैसा ही है ये. Okay, only thing is the name has changed. It becomes an SBP reserve now. And this will go as a part of your equity. Sir, equity क्यों? Sir, because what you are going to issue to them is equity shares. In this question, what you are going to issue is share options. You are issuing them share options. So they will get equity shares in the future. So already you have an obligation to deliver your own equity instruments. You have an obligation to deliver your own equity instruments, and therefore that becomes a credit to the SBP reserve. That becomes a credit to the SBP reserve. Are we okay with this? Yes. So 3 years you will pass this entry. 3 years you will pass this entry. At the end of third year, they will come to exercise. At the end of March X3, all of them exercise the options. So SBP reserve account balance kitna hoga? Obviously the total of this. So that is 4,10,000. So 4,10,000 to equity share capital, 4,10,000. Are we okay with this? Yes, are we okay?
Yes, sir.
Okay. So that takes care of this question. Simple one. 48. Okay. Can you do this one question for homework? Question 1 from Test Your Knowledge section, page 7.110. Same question, 100 shares, 1,000 employees, grant date fair value, expectation of 97 followed by 91%. So can you do this for me?
Yes, sir.
कुछ है ही नहीं उसमें, कर लो. It's the same thing. Okay. All right. Fine. So that takes care of 3 questions already. Okay. Next one is, okay. This is an interesting one. In fact, this is there in your earlier module. Okay, this is there in the old module, old syllabus. Okay, old syllabus की बात करेंगे, then this is the time when we had studied. Okay, this is not the old syllabus per se जो हाल फिलहाल में जो syllabuses change हुए हैं. Okay, this is almost 11 to 12 years back, more than that in fact, when we were studying. Okay, but the principles remain the same. The principles remain the same. But this question is very interesting. Okay, so that is why it's put in a very interesting and nice question. Okay. The following particulars in respect of stock options granted by a company are available. Total employees covered 525. Number of options per employee 100. Okay, I will read it from here. Okay. Let's read it from here. Yeah. Vesting conditions, continuous employment for 3 years. So tell me, which type of condition is this? Performance or service?
Service.
Service condition. It's a service condition. Okay. All right. Fine. So that takes care of the condition type. Vesting condition 3 years. Nominal value 100. Vesting period 3 years. Exercise period 1 year. Fair value of options per share on the grant date 30. Exercise price per share is 125. All right. Position at the end of year 1. At the end of year 1, you expect the estimated annual rate of departure as 2%. Actually, who have left is 15. At the end of year 2, departure is 3%, left is 10. At the end of year 3, it is 8. Number of employees entitled to exercise the option is 492. Okay. So 492 is nothing but 525 minus 15 in year 1, 10 in year 2, 8 in year 3. Even if 492 was not given, you would be able to calculate that. Number of employees exercising the option is 480. Number of employees not exercising the option is 12. So that is nothing but 492 minus 480. Are we okay with this? Compute the expenses to be recognized in each year. Also show the journal entries and ledger accounts. Are we okay with the question? Have you understood the question?
Yes, sir.
Yes, okay. So let us proceed to do this. Probably you would have done this. So at the end of the first year, how many employees left? 15. Yes. So at the end of first year, I actually have only 510. Tell me one thing. This 510, is it estimate or is it actual?
Actual.
Estimate, sir.
Actual.
Who said beta it is estimate?
Oh, sorry.
It's not
Yes, sir. It is actual.
It is actual. ठीक है. Actual में पूरे साल में 15 employees left. So 510 is actual. ये मेरा actual है. So now in the next 2 to 3 years, next 2 years, right? Sorry, yeah. Next 2 years, I expect 2% to leave. I expect 2% to leave. This is annual rate of departure. Look at the words. It is annual rate of departure. It's not total departure. So in year 2, 2% will go. In year 3, a further 2% will go. Are we able to understand this?
Yes, sir.
It's not 2% cumulative. Okay? It's 2% on an annual basis. So therefore, total number of options. How can I calculate? Very simple. Please pay attention. Calculation is there down, but we will just discuss this. See, 510 employees are there. Each employee is getting 100 options. 98% of these employees will remain at the end of year 1. So this is year 1. Sorry, end of year 2. Year 1 to 510 hai. So this is end of year 2. And iska 98% will be there at the end of year 3. Are we okay with this? Yes. If you have any doubts, please feel free to ask. No need to hesitate. Yes. Clear. Karthik, Hemant, Monica, Pooja, all clear?
Yes, sir.
All clear. Okay. Who else? Usha, Niranjan, Kishore. Mamta, all clear? Okay. Okay. All right. Hemant has a question. Should it not be 97% at the end of year 2? I wanted this question to come. Okay. हम कहाँ पर है हेमंत? Where are we? We are at the end of year 1. This estimate of 3% I can come to know only when I am in year 2. अभी तो मैं year 2 में पहुंचा ही नहीं हूं. I am in year 1. So in year 1, I expect that 2% ही जाएंगे year on year basis. The 3% is a data point that is coming to me when I complete the second year. I cannot see the future, right? I am on today's date. So 510 employees. This will be the number at the end of the second year. Usme se another 2% will go. So this will be the number at the end of the third year multiplied by 100 options per employee. तो आप ऐसे भी कर सकते हो. You can do it this way also, which comes to 48,980. Which comes to 48,980. Okay. Now, there may be some people, some students who will say that, sir, we will take 510 employees into 98% into 98%. So how much does it come to? Bolo. It comes to 489.80 employees. Yes or no?
Yes, sir.
Yes.
Yes.
अभी एम्प्लॉय आधा आधा फ्रैक्शन में तो नहीं रहेगा ना. So we will round it off to 490 employees. This multiplied by 100, 49,000 options. Are we okay with this? Yes. और अगर हम ऑप्शन लेवल पे करेंगे, इफ आई डू डायरेक्टली एट ऑप्शन लेवल, 48,980 ऑप्शंस. ओके, ठीक है. Everyone is clear why this 20 difference is coming? That is because I rounded off the number of employees. 489.8 जो है, I made it as 490 and did the calculation. Yes or no?
Yes, sir.
एग्जाम में कौन सा कर सकते हो? Both are acceptable. Both are acceptable. Institute has gone for this one, which is perfectly fine. Okay, which is perfectly fine. Some people can go for this. This is also perfectly fine. See, it's just a rounding off mechanism that is there in the second case. That's it. Okay. So both are perfectly fine. Institute has taken with the fair value of options. So we shall take that. So 48,980. Each employee fair value is 30 rupees. So multiplied by 30 gives you 14,69,400. This is for the next 3 years. So uska 1/3 is 4,89,800. Did I recognize anything earlier? Answer is no. So the first year's expenses 4,89,800. Are we okay with this? Yes.
Yes, sir.
Okay. Can somebody try year 2 by themselves and confirm to me what will be the expense? Try year 2. You guys are trying? Devraj, Karthik, Hemant, Kishore, Mamta, Jeannie.
The 485 options.
485 options or 485 employees.
Multiply by 100. 485,000.
That's right. That's right. 48,500. So what is the expense you will book in year 2?
The total cumulative expense to be recognized till year end 2 is 9,70,000 minus first year जो हमने recognize कर लिया, that extent we will recognize in second year.
Hanji. So 9,70,000 is right. So you will be taking it minus 4,89,800. So net जो हमारा recognizable expense होगा, that is 4,80,200. Absolutely right. Okay. All right. Sir, will it be right if we just take the fair value on a proportionate basis for each year during the vesting period and take actual number of employees in each year? See, when you take actual number of employees, no harm in that. So what you are basically trying to tell, Karthik, correct me if my understanding is wrong. You are saying that, sir, हमको ये estimate and all नहीं करना है. We will not do this estimate business. At the end of each year, like end of year 1, how many employees I had? 525 minus 15. So 510 employees multiplied by number of options multiplied by the grant divided by 3. Estimate to estimate भूल जाओ. Second year में 510 minus 10, 500. So we are not going to do any estimate. Rather, we will take the total employees, divide the expense for the remaining period and deduct what is recognized earlier. That's what you are saying, right? We will ignore the estimation part. Yes. Is that what you are saying? Personally, it's not right to do that way because this is something which is vesting after 3 years. So therefore, जो भी attrition and all is there, it would be advisable that you show it. It would be advisable that you show it. You cannot see third. Okay, so you are saying fair value itself, you want to do it on a proportionate basis. So 10 for the first, 20 for the second, 30 for the third. See, you can do this. In fact, this is only what is happening. See, 30 divided by 3 for the first year. 30 multiplied by 2 divided by 3. So therefore, each year there will be a proportionate fair value movement that is happening. That's right. But I cannot show that because in your calculations, you need to present the fact that you are taking 30 as your fair value at the date, at the grant date. You're taking fair value at the grant date as the basis for your calculations. And therefore, you cannot do a pro rata fair value. That presentation would be wrong. Answer will be the same. Presentation will not be right. Is it okay? Yes. All right. So year 2 का सबने कर दिया. Ginny, are you okay with this? Yes. Year 2. Others? Have you guys tried? Okay. So see, at the end of year 1, I had 510 employees. Further 10 left. So now I have 500. Estimated attrition is 3%. So therefore, you will have 485 employees into 100. So 48,500 options. Multiplied by fair value on grant date 30. So that comes to 14,55,000 into 2 by 3. So 9,70,000 minus 489. So 4,80,200. 4,80,200. And finally, 8 employees left. So 492 into 100. So 49,200 multiplied by 30. So 14,76,000 minus 9,70,000 gives you 5,06,000 as the expense that needs to be booked in year 3. Are we okay with this?
Yes, sir.
Yes.
Yes, sir.
Okay. Very good. Okay. Perfect. So that takes care of the ledger accounts also. Employee compensation expense account debit to SBP reserve for each of the 3 years. SBP reserve, you are having a credit by employees compensation expense. So at the end of year 3, you will be having a balance of 14,76,000. Yahan tak everybody is comfortable?
Yes,
Yes.
sir.
Yes. Year 4, what is happening? Year 4, what is happening is there is an exercise. Yes, there is an exercise. And out of this total 492 employees, 480 employees exercise, 12 employees do not exercise. 12 employees do not exercise. Okay. So कैसे करेंगे? So let us look at year 4. Okay. 48,000 employees exercised. Are you given exercise price?
125.
125. That's right. So bank account debit 48,000 into 125 per share to share-based payment reserve account 60 lakhs to SBP reserve 60 lakhs. Okay. Now these 48,000 employees, okay, these 48,000 options should now be converted into equity shares, right? They cannot remain in SBP reserve. It has to be converted into equity shares. So let us look at the data. Fine. Okay. Okay. The shares are having a nominal value of how much?
100 rupees.
Okay. So 48,000 ke liye the credit should happen at 100 rupees, 48 lakhs. Is everybody in agreement with 48 lakhs?
Yes,
Yes,
sir.
sir.
Yes. Yahan pe there is no doubt. Okay. Now, I have received 125 rupees from each employee. Is it okay?
Yes, sir.
Yes, sir.
Achha. I have also received 30 rupees, but that is in kind, not in cash. Is it okay? सर काइंड कैसे हो गया? कौन सा काइंड दिया एम्प्लॉइज ने? बोलो.
Service.
Service. The 3-year service that they are rendering is valued at 30 rupees per option. Yes or no? Yes or no?
Yes, sir.
See, don't get sentimental about the numbers. पैसे का 125 और 3 साल मेहनत किया तो 30 rupees. Don't get sentimental about that. How can that happen and all? It happens like that only. Okay. But my key point is employees gave cash of 125 plus service for 3 years, the value of which is 30 rupees. Is it okay?
Yes, sir.
So therefore, the total consideration that they have given is 155 per share. Okay. So out of 155, nominal value is 100. So the securities premium is 55. Are we okay with this?
Yes, sir.
Yes. तो बस वही है securities premium 48,000 into 55 and total SBP reserve is 74,40,000. Are we okay? Yes.
Yes, sir.
See, why 30 is added? Okay. See, employee is getting the shares, right, Hemant? So Hemant, tell me, to get these shares, what is the employee giving? See, there is employee is getting shares for which he has to give a consideration, right? So employee is paying how much? Employee is paying 125. But is it only 125? Hemant, सच में पूछो अपने आप से, क्या वो सिर्फ 125 दे रहा है या फिर इज ही गिविंग समथिंग एक्स्ट्रा? सर एक्स्ट्रा क्या देगा? वो 3 साल रहा ना कंपनी में, यस। वो 3 साल वहां काम किया, यस। इफ ही हैज वर्क फॉर 3 इयर्स, उसका भी तो वैल्यू होना चाहिए, यस और नो? There has to be a value of that. So the value of that is 30 rupees. So employee has paid cash of 125 and 30 rupees by being in respect of this, 30 rupees by being in service for 3 years. And therefore total value is 155. Okay. All right. And finally, कितने employees ने exercise नहीं किया? How many employees did not exercise the option? 12 employees. That is 1200 shares multiplied by 30 per share. So that comes to 36,000. That comes to 36,000. Are we okay with this? Yes. 1200 options multiplied by 30 per share. So
Yes,
that
sir.
comes to 36,000. So SBP reserve debit 36,000. The question is, where should it go? It will go to retained earnings. It will go to retained earnings. See, you cannot leave securities, I mean, this share-based payment reserve as idle, especially when there are no options left to be exercised. And therefore, you will be leaving it as, securities premium तो वैसे रहेगा 55. Yes. Are we okay with this?
Yes, sir.
Accounting wise, all the 4 years are clear. Yes. So that takes care of this question. Anybody wants to add something or any doubts? No doubts. तो आगे बढ़ते हैं. Yes. So this is done. Okay. Can you try ICAI RTP November 22 question by yourself? Okay, before
Yes,
that.
sir.
No. Wait, I think it's better that I do it because this is graded vesting. Okay, this is graded vesting. Okay, we will do this together, but we will do this after the break. Okay, I'll take a 10-minute break. We will pick up this question after the break and close it because I could have given you, but there is a graded vesting, 20% in year 1, 40% in year 2, and 40% in year 3. So graded vesting here, we will do this after the break. Okay, take a 10-minute break, please. To this question, this is related to graded vesting, again from the RTP. Following particulars. Okay, so let us go to the question itself. Following particulars in respect of stock options granted are available for a company. Number of employees covered 400, nominal value is 100, exercise price is 125, and options per employee is 60. Shares offered were put into three groups. Group 1 was 20% of shares offered with a vesting period of 1 year. So vesting period 1 year, uske liye 20% of the shares on offer will be given. Group 2, 40% of shares, vesting period of 2 years. Group 3, balance 40%, vesting period 3 years. See, what happens is employees also will say, sir, we have to remain for 3 years to get to your stock options, particularly in high attrition related industries like your IT sector. So here employees switch jobs at the drop of a hat, right? And therefore, to keep them, they will provide stock options, but they will provide them on a graded basis, okay? Gradual basis. So, एक साल में रहे, 20% you will get. 2 साल रहे, another 40%. Third year also you will be there, another 40%. So that is how this is known as graded vesting. Fair value of options per share on the grant date was 10 rupees for group 1, 12.5 rupees for group 2, and 14 rupees for group 3. Sir, why will the fair value differ for each of the three groups? Because vesting period is different. Okay. So obviously the fair values will undergo a change. So position in the first year, number of employees left is 40. Expected to leave in year 2 is 36. Expected to leave in year 3 is 34. So how many employees we have? 400. 440 left in first year, 36 in second year, 34 in the third year. Employees exercising options in group 1 is 350. Okay. Position in the second year, 35 employees left. Employees to leave in year 3 estimate is 30, and employees exercising group 2 options is 319. In year 3, 28 employees left. Employees at the end of last vesting period, 297. Employees exercising options in group 2, 295. Options not exercised immediately on vesting were forfeited. Compute expenses to recognize in each year and show the important accounts in the books of the company. Are we okay with this? Have you understood the question? Yes. Okay. So let us understand the calculations. Okay, let us understand the calculations. Total shares under ESOPs. How many have I given? 60. Yes. Ye 60. Is it coming entirely in year 3 or is it happening in phases?
Phases, sir.
Phase wise it is happening. So the phase wise is 20, 40 and 40%. 20%, 40%, 40%. So group 1 is vesting period of 1 year only. That is 20%. So 12 shares. You stay for 1 year, take 12 shares. You are entitled for that. You stay for 2 years, you will get 12 plus 24 shares. So 36 shares. You stay for 3 years, you will get all the 60 shares. I hope you are okay with this. Okay. I hope you are fine with this. All right. Now let us look at group 1. When I talk about group 1, please don't get confused with group 2 and group 3. मैं अभी group 2, group 3 की बात ही नहीं कर रहा हूं. Okay. So what you can do is don't look at this. This is going to create confusion. Okay. All right. Okay. So now, year one, how many employees left? 40 employees left. We started with how much? We started with 400 employees. That means how many are left?
360.
360. Out of 360, how many have exercised the options? 350. That means 10 people have not exercised the options. Are we okay with this? Yes? Bolo yaar.
Yes, sir.
Okay. Now, is this information relevant for year one in respect of group one options? Estimate of
No,
employees,
sir.
it's not relevant for group one. It becomes relevant for group two and group three, but it is not relevant for group one. Okay. So therefore, expected to leave in the future is not applicable. नहीं चाहिए मुझे, options already vest हो चुके at the end of year one. So number of employees eligible 360. Options expected to vest 360 into 12, 4,320. Fair value per option is 10. They have already given to you. Yes, 10 for group one. So 43,200. And this is only for 1 year. So 43,200 will be your expense. Employees not exercising ESOP, 10 employees. How it is 360 minus 350. Are we okay with this? Yes?
Yes, sir.
Perfect. So that closes your first point. First option. Okay. Now we come to the group 2. Group 2 में कौन आएंगे? Who will be there in group 2? Employees who will complete the vesting period for 2 years. That means you tell me one thing. Is year 1 data relevant for group 2?
Yes, sir.
Yes,
350.
sir.
Definitely year 1 is relevant. Because year 1 they will complete, then they will move on to year 2. Yes or no?
Yes, sir.
Yes, sir.
Yes, sir.
Year 1 data becomes relevant. And estimate of employees to leave in year 2. Is it relevant?
Yes, sir.
Yes. Estimate of employees estimated to leave in year 3. Is it relevant?
No,
Yes,
sir.
sir.
No, because group 2 ka vesting period is only 2 years.
Yes,
So
yes, sir.
estimated employees to leave in year 3 is irrelevant. Is it okay? Pooja
Yes, sir.
समझ रहा है? Yes.
Yes, sir.
Jeannie, are you able to follow?
Yes,
Hemant,
sir.
Karthik, Mamta, Niranjan.
Yes,
Okay,
sir.
perfect. All right. ठीक है. So now let us proceed. So year 1 का calculations 400 minus 40. 360 is the actual one. Okay. 360 is the actual employees who are there at the end of year 1. I am expecting a further 36 employees to leave in the future. So my estimate at the close of year 1 is 324 employees would be eligible. Are you okay with this? Yes. So if 324 employees are eligible, each employee gets 24 shares. So 324 into 24, 7,776 options. So far, is it clear? Yes?
Yes, sir.
Perfect. Multiplied by fair value. Fair value is 12.5. So 12.5 से multiply किया 97,200. Is this expense for 1 year or 2 years? 97,200. Think and answer. Is it for 1 year or for 2 years? Absolutely right. Karthik's given the right answer. Anila, what about you? Jeannie, what about you? Is this expense for 1 year or for 2 years? Mamta?
1 year, sir.
1 year, sir.
1 ईयर नहीं बेटा, ये 2 साल का है ना। सी 360 I expect
Yes,
further
we
36.
estimated is included.
Estimate is included. That's right. Estimate is included. अगले साल भी कितने लोग जाएंगे? 36 are going to go. I am estimating 36 to go in the next year. So my total options expected to vest is 7,776. But when is it expected to vest? At the end of year 1 or at the end of year 2?
2.
At the end of year 2, and therefore 97,200 is the expected expenditure for year 1 only, or for year 1 and 2 cumulatively?
1 and 2 cumulatively.
1 and 2 cumulatively. So therefore expense for year 1 is divided by 2, so 48,600. Are we okay? Yes.
Yes, sir.
Perfect. प्रीवियसली मैंने कुछ रिकॉग्नाइज किया था, आंसर इज नो. बट सर 43,200 किया था. 43,200 इज अ डिफरेंट प्लान ऑल टुगेदर. Don't get confused with that 43,200. That is for those options which are vesting in year 1. This is for those options which are vesting at the end of year 2. So ये तो प्लान ही अलग है, समझ लो. You treat it as if it is a different plan altogether. Are we okay with this?
Yes, sir.
So in respect of this plan, I have not recognized anything in year 1, and therefore expense for year 1 will be 48,600. So far, is it okay?
सर तो जो टैन एम्प्लॉय लेफ्ट हो गए थे वो लास्ट 350 रह गए थे, इट्स इररिलेवेंट फॉर द ग्रुप पोजीशन 2, राइट?
Yes. 350 employees exercising the options is irrelevant. 350 employees exercising the options right now is irrelevant. Are we okay with this?
यस सर.
Because ये तो ऑप्शन 1 में एक्सरसाइज किया ना उन्होंने, ऑप्शन 2 में तो दे आर येट टू एक्सरसाइज.
ओके सर.
Year 2. So this 350 is irrelevant. Okay. Coming to the next one, year 2. Year 2. I start with 360 employees because 40 तो actually चले गए. Yes. 40 ने resign किया ना year 1 में. 40
Yes, sir.
people resigned. So I'm having 360 opening balance of employees. Out of 360, 35 left. Position on second year, 35 left. So I'm left with 325 employees. Is it okay?
Yes, sir.
Number of employees expected to leave in year 3. This 34. Is it relevant for the second plan? It's not.
No, sir.
Because options are vesting at the end of the second year itself. Third year में plan है ही नहीं. The plan ends in year 2. So how many resign in year 3? How many do not resign? How many exercise? All of that is useless for me as far as the second plan is concerned, as far as the second group is concerned. Okay. So total employees eligible is 325. Okay. All right. So therefore 325 into 24. Total number of shares expected to vest is 7,800. Are we okay with this?
Yes, sir.
Yes, sir.
So my 97,500 is your expense, right? Read.
Yes, sir.
Yes. Out of 97,500, have I recognized something in year 1?
48,600.
Yes. This 48,600. This is the one. 48,600. So I'm going to recognize 48,900 in year 2. I'm going to recognize 48,900 in year 2. All clear so far?
Yes,
Yes?
sir.
अच्छा, but sir 319 employees are exercising. हाँ तो ठीक है ना. So that is the exercising. फिलहाल तो we are in the vesting phase. Exercising, whatever happens, we will see to that later. अभी तो right now we are vesting the options. हम कैलकुलेट कर रहे हैं एम्प्लॉइज वेस्टिंग पीरियड में क्या हो रहा है ऑप्शंस के रिलेशन में. यस. अभी तो एक्सरसाइज दूर है, पहले वेस्टिंग तो कर ले, राइट. And finally, coming to third group, here all the data points are relevant. Here all the data points are relevant. So therefore, I started off with 400, 40 people left in year 1, so 360. Number of employees expected to leave in the future, 36 plus 34, so that is 70, right? So 360 minus 70, I expect 290 employees to become eligible. I expect 290 employees to become eligible. So 290 into 24, 6,960 employees, 6,960 options are expected to vest. Tell me, is this expense 6,960 into 14? Is it for 1 year? Is it for 2 years? Is it for 3 years?
3 years, sir.
3 years, because the life of the option here is 3 years. Vesting, the vesting period is 3 years. So this expense also rightly is for 3 years. So 6,960 into 14, 97,440 is for a period of 3 years. So पहले साल का खर्चा कितना होगा? 32,480. Did I recognize anything previously? Yes, sir. 48,600. No, that is
No, sir.
group 2. 43,200. No, that is for group 1. Group 3 के case में, this is the first year. I have not recognized anything and therefore it is 0. So 32,480 is the expense for the first year. I come to the second year. Second year में 325 employees are there at the end of year 2. Bolo, is this 325 actual or is this estimate?
Actual.
Actuals. I hope everybody is on the same page with us. And the more you interact, the more we understand. Okay. All right. So 325 actual. Now, number of employees expected to leave in the future. That means in year 3. Sir, कौन सा लेंगे? Should I take 34 or should I take 30?
30, sir.
Yes, 30. Why 30? Why not 34? Jeannie, Hemant, Karthik. Okay,
Position on second year, they have given us 30, sir. We have
yes,
to
I
take
am
that.
at the end of year 2. And because I am at the end of year 2, I now have a better estimate. So now I think 34 won't leave, only 30 will leave in the future. So 30 employees expected to leave. Okay. So 295 into 24, 7080 into 40, 99,120 rupees into 2 by 3. 2 साल का खर्चा, because 2 years are gone. So 66,080. Out of 66,080, I have already booked 32,480. And therefore, your expense for the second year in group 3 is 33,600. 33,600. Are we okay with this?
Yes, sir.
Perfect. Coming to year 3 finally. Coming to year 3. 325 employees I start with. That is this 325. And employees left is 28. So 325 minus 28, 297. Employees expected to leave in the future. Is it relevant now? Not relevant.
No,
This
sir.
program gets over in the third year. So 297 into 24. So 99,792 becomes your spend for the cumulative 3-year period minus what is recognized up to 2 years. So 66,080. So last year's expense will be 33,712. Are we okay? Yes.
Yes, sir.
Yes, sir.
Everyone? Okay, fine. So now, year 1, what is your total expense? Sir, 43,200, 48,600 from group 2 and 32,480 from group 3. So the total of that comes to 124,280. Are we okay? Yes. Hemant, Karthik, Kishore. Perfect. Okay. Jeannie also confirmed. Okay, fine. Coming to the next one, year 2. Year 2, 48,900. plus 33,600. So that comes to 82,500. Year 3 में तो यार एक ही है 33,712. So that is the group 3. Are we okay with the expenses? Yes. Girls?
Yes, sir.
Perfect. So entries, employee compensation expense account debit to SBP reserve. So first year 1,24,280, second year 82,500, third year 33,712. ठीक है? All good?
Sir, but some issues are happened in first year one, right?
आएंगे अभी. That is the exercise you are talking about, right? Correct? आप exercise की बात कर रहे हो?
Actually, option 1 is closed and option 2 is closed and option 3 is closed, and some allotment are happened in option 1 and option 2 and option 3 as well.
Yes, so we are coming to that. Now we finish the vesting for the 3 years. एक एक करके करते, we'll do one by one. If I take you through vesting, then exercise, vesting exercise, it will be a lot of confusion. Okay, so first we finish the vesting. Are we convinced on the vesting part for all the 3 groups?
Yes, sir.
Yes, sir.
Okay, perfect. Now we start up with the exercise, what Monica was telling. Sir, something is exercised in year 1, something is allotted in year 2, something is going in year 3. Some people did not exercise. So many things are there, sir. So what to do? So let us go step by step. First of all, when I exercise the options, what am I getting in return?
Shares.
Shares. So shares होगा तो 2 things should be there. One is nominal value and the other is security.
Security premium.
तो सबसे पहले calculate nominal value and securities premium for all the 3 categories. Okay. So group 1, 2, 3. Exercise price is the same, 125. Okay. Value of service received, which is nothing but the fair value of the options, is 10, 12.5 and 14. 10, 12.5 and 14. So totally the consideration is
So
130.
we can't assume that the 10 rupees is included in that exercise price already, 125.
No, na. If 10 rupees were to be included in 125, why would the employee pay 125?
But it is saying exercise price, nowhere it mentions that employee is paying that 125, no, sir.
We come to the definition of exercise price. Somewhere we saw the definition of exercise price. Grant date. Performance conditions. Exercise period. Okay. Okay. Here it's not given. Okay. Exercise price. Okay, fine. We did not cover it, but exercise price is the amount that the employee will pay to the entity for getting the shares. Okay, it's a payment in cash that will be made by the employee for acquiring the shares. Okay.
Okay, sir.
That's the definition of exercise price. Maybe it will be there somewhere ahead. We will come to that. But as of now, just remember that. Okay. We will look at that later on when we come. Okay. All right. Fine. So 125 he will pay, plus he has rendered service. He or she has rendered service for 1 year in group 1, 2 years in group 2, 3 years in group 3. The value of those services is 10 years for group 1, 12.5 for group 2, and 14 for group 3. So total consideration that is received is 135, 137.50, and 139. Minus the face value. So this is your premium, 35, 37.50 and 39. Are we okay with this part so far? Yes? Perfect. Perfect. Now, I want you to help me out. Okay. This is the data in the question. Okay. Tell me, year 1, group 1, how many employees have exercised the option?
350, sir.
350 employees have exercised the option. Out of how many employees?
360.
360 out of 360. Is everybody clear about 350 and 360? Yes.
Yes, sir.
Yes, sir.
How much money the company has received?
350 multiplied by
into the
125.
350 multiplied by rupees 125. Is 125 per employee or per option?
Per option.
तो कितने ऑप्शन हैं? 60 into 20%, 12 options.
12 options.
Yes. So how much money the company has received? Go on.
52,500.
5,25,000.
5,25,000. Did everybody get this amount? 5,25,000?
Yes, sir.
Yes, all right. So this 5,25,000 will mean face value. What is the face value of this?
100 rupees.
Yes, so 350 into
1,000.
And what is the securities premium?
1,05,000.
350 into 12. Don't say 1,05,000. Those who did 1,05,000 would have done 5,25,000 minus 4,20,000, right?
Yes, sir.
Don't do like that. I'll tell you why.
Into 35.
Into 35. Yes. Sir, why I cannot do? Because employee is not paying only cash. Employee has also done some efforts for 1 year. Okay. He has gotten himself the entitlement by working for 1 year. Uska fair value 10 rupees hai. That fair value is 10 rupees. Okay. So 35. So 350.
1,47,000.
Yes. Perfect. So securities premium is 1,47,000. Okay. Now, sir, something is happening here. Sir, face value plus securities premium, इसका टोटल कितना होता है? 420 plus 147?
5,67,000.
5,67,000. But sir, money has come only 5,25,000, na? So how am I recognizing? Array, he has given services, na? He's given services or not?
Yes, sir.
Yes, sir.
So when he has given those services, it will be coming out from SBP reserve. Na, आपने accumulate कहाँ किया? You have accumulated in SBP reserve. Yes or no?
Yes, sir.
Yes, sir.
Will be met out of that. ठीक है? Yes. So is it clear so far?
Yes,
sir.
sir.
All right. Now we come to the next part. Out of 360, 350 employees only exercised. There are 10 employees who have not exercised. Yes? Yes?
Yes, sir.
Yes, sir.
Can they exercise in the future? Answer is no. The question
No.
says options not exercised immediately on vesting were forfeited. So 10 employees, 12 options each employee has done a work equivalent to 10 rupees per option. This is a waste. So 10 into 10, 100 into 12,
1,200.
इसको हम क्या करेंगे, वी विल फॉरफिट इट। फॉरफिट मतलब वी विल रिमूव इट फ्रॉम एसबीपी रिजर्व and transfer it to retained earnings. Transfer it to retained earnings. Are we okay with this?
Yes, sir.
Yes, perfect. So now let us come to the solution. Okay. All right. So SBP reserve, year 1,24,280 has come. Yes, that is this figure. Okay. Yes or no?
Yes, sir.
Employee compensation expense account debit to SBP reserve. So SBP reserve credit is 1,24,280. Then the employee has received the entity has received 5,25,000. Number one, it has forfeited 1,200. It has allotted shares having face value 4,20,000 and securities premium of 1,47,000. So the balance carried forward in SBP reserve is 81,080. Are we okay with this? Yes. Are we okay with this? Boys and girls?
So generally we transfer this fund into retained earnings,
आप
right?
नहीं कर सकते retained earnings में transfer because this is pertaining to group 2 and group 3. You are
Okay,
able to,
sir. Okay,
this
sir.
is 32,480 plus 48,600, which is this value.
Okay, sir.
These are
Fine.
live options. इसमें अभी जान बाकी है 1 साल और 2 साल का respectively. Okay. So therefore,
Yes, sir. Yes, sir.
we will come to how much? 81,080. Just give me a minute. I have a call. Just a minute. Yeah. Sorry for that. Okay. Is this okay? 81,080?
Yes, sir.
Okay. Coming to the next one, year 2. So we start with 81,080. Now you will tell me and I will do the working. Okay. Again, the same fashion. Okay. Perfect. Now tell me, year 2, how many employees are giving you the money?
319.
319. So that will be 319 into how many
125.
employee? 125. And how many options per employee?
24. 24 shares.
24. So that comes to how much?
9,57,000.
9,57,000. Perfect. Perfect. All right. Next, how many employees are not exercising the option?
6.
6 employees. But did they work for 2 years?
Yes, sir.
Yes,
Six
sir.
So 24 into
into 12.5.
12.5. So this has to be removed from there. So that comes to how much?
1,800.
1,800. This will be removed from SBP reserve and transferred to retained
Retained
earnings.
earnings.
Perfect. Perfect. And finally, this 319 options, I will have securities premium and face value.
37.5.
37.5 is the securities premium. So 319 into 120 into 24 into rupees 100. Sorry, this is securities premium, right? So 37.5.
2,87,100.
Perfect. 287,100. And face value
319 into 24 into 100.
So that comes to
7,65,600.
7,65,600. Okay. All right. So that's it. All done. So now we come to the ledger. So this will be a credit 9,57,000. 1,800 will be a debit. 7,65,600 will be a debit and 287,100 will be a debit. Are we okay with this?
Yes, sir.
Perfect. And expense for the period is how much? 82,500. 82,500. Is it okay?
Yes, sir.
All right. So that will come as a credit. So come to year 2. All right. And then let us proceed. 82,500 from second year, 9,57,000 from the amount collected, 1,800 forfeited, 765,600 face value, 287,100 is the premium. Okay, so this is the total. And balance carried down is 66,000. This is the live option value of the third year of the group 3. Is it okay?
Yes, sir.
If you have any doubt, you can check. It is group 3, 66,080. Okay. This value. Yes or no? All right.
Yes, sir.
Perfect. So 66,080. And in this 66,080, the third option, 297 employees have are there,
Exercised.
out of which 295 have exercised, right? Employees present and employees exercised, 295. So quickly, 295 into 125 rupees
Into 24 shares.
24 shares. That will be the cash receipt.
8,85,000.
That's right. Out of which 100 will go towards premium and the security, 100 will go towards face value and securities premium will be 39 rupees. Perfect. Perfect.
7,08,000 security, the share capital, and 2,76,120 security premium.
Perfect. Perfect. Jeannie, are you following? Yes.
Yes, sir.
33, 66, 8 lakh 85, 7 lakh 8, and this is the
And
forfeit.
reversal is 2 into 24 into 14,
Perfect.
672.
672. So at the end of the third year, SBP reserve is closed. SBP reserve is closed. Are we okay with this, everyone? Yes. Jeannie has confirmed. Hemant, Karthik, all clear? Perfect. So now for your exam, if you revise this one question, it will be equivalent of revising 6 questions. Yes? Anna? Group 1 is 1 question. Group 2 is 2 questions. Group 3 is 3 questions. Yes or no? So mark this as a very, very important summary question to be revised from exam perspective. It covers vesting, it covers exercise, it covers forfeiture. It covers journal entries, it covers ledger accounts. और क्या चाहिए? Yes, or what else you need? So one question, very beautiful question by the institute. So please do this. It's there in the November 2022 RPP also. Okay.
सर इससे इतना यानी ये क्वेश्चन इतना इफेक्टिव है फिर भी न्यू सिलेबस में से क्यों हटा दिया गया? अभी आप नहीं दिखाते तो
नहीं आ जाता ना, आरटीपी में आ गया ना नवंबर में.
अच्छा आरटीपी में.
आरटीपी में इंस्टीट्यूट ने डाल दिया है नवंबर 22 में.
ओके सर ओके.
The institute has such a huge bank of questions that
यस
मतलब if they go on adding that questions, फिर तो आपका स्टडी मॉड्यूल बुक में फॉर्म में आएगा नहीं, फिर वो सॉफ्ट
यस
कॉपी
सर
में
यस
आएगा.
सर
Yes. So I think, but it's a very, very effective question. Okay, so go through this. Okay, so that takes care of vesting condition, which is a service condition. Okay. Coming to the next one, vesting condition, which is a performance condition. Okay. हमने दूसरा पढ़ा था vesting condition in the nature of service, in the nature of performance. In the nature of performance, we have 2 types. One is market-based performance condition, and second is non-market-based performance condition. Are you able to correlate?
Yes, sir.
Okay. So, non-market-based performance condition, what are you going to do? Non-market-based performance condition will be conditions like increase in sales, increase in EBITDA, increase in contribution, or decrease in costs. All these are non-market-based performance conditions. So therefore, how are you going to do the accounting for this? So one thing we have to understand, a non-market-based performance condition means the impact will not be considered in the fair value of the shares at the grant date. Yes, because this has nothing to do with the market price. See, fair value is calculated using binomial or Black and Scholes model. And to a great extent, these models rely on the market values along with certain indicators. They are given those 6 indicators that is there in the theory. Life of option, exercise price, all those things are there. Okay. Now, when I talk about non-market based conditions, none of those conditions will be forming part of the valuation. Increase in EBITDA, it's not an indicator for applying Black and Scholes model. Increase in sales revenue, it's not an indicator, or it's not an input for doing the valuation. It's not an input for doing the valuation. And therefore, this non-market condition का जो impact है, the impact of the non-market based performance condition is not visible in the fair value, is not visible in the fair value. So coming to the converse, opposite की बात करें, market based performance condition is already considered in the fair value. Are you able to understand? If I am saying that the market price should increase by 20% over the next 4 years for options to vest, this increase in market price is already factored in the fair value of your options. Are you able to follow? Yes or no?
Yes, sir.
Yes. So when I talk about market-based performance condition, the impact of change in market price is factored when I determine the fair value of option at the grant date. But when I'm doing a non-market-based performance condition, those targets are not my inputs for fair valuation of the option at the grant date. And therefore, when I take the fair value at the grant date, it is not an indicator of meeting the performance conditions which are non-market based. And therefore, those non-market based performance conditions, I will have to determine when I calculate the number of options that are expected to vest. The number of options that are expected to vest that will be vested. Are you able to follow now? Yes. Are you able to follow? Yes. Monica, Anila,
Yes, sir.
Hemant, Karthik, you guys are able to follow. Okay, perfect. So now let us proceed. Let us now proceed to calculate. Let us understand the question. You will then be able to calculate, do the workings and understand the application also. Okay. ठीक है. Ankita Holdings grants 100 shares to each of its 500 employees on 1st January. X1. Employees should remain in service during the vesting period. The shares will vest at the end of first year if the company's earnings increase by 12%. End of year 1, earnings increase by 12%, shares will vest. If not, then it will vest by the end of second year if the earnings increase by more than 20% over the 2-year period. Even in the 2-year period, if it doesn't vest, then it moves on to the third year if the earnings increase by more than 22% over the 3-year period. Are you able to understand this? Condition समझ में आ गया? Yes, Mamta? Oh, Jeannie
Yes,
has.
sir.
You understood the question. So year 1, I will check. If the earnings have not increased by 12%, then options won't vest. Then I will take the vesting period as 2 years. At the end of 2 years, if it does not vest, I will take the vesting period as 3 years. Are you okay? So the vesting period goes on changing because this is a performance related condition. This is a non-market based performance condition. Okay. The fair value per share at the grant date is 122 rupees. In 20X1, earnings increased by 10% and 29 employees left. The company expects that the shares will vest at the end of year 2. So at the end of year 1, expected vesting period is how many years? 1 year, 2 year, 3 years?
2 years.
2 years. Because company thinks it will meet the target at the end of year 2. At the end of 20X, the company also expects that additional 31 employees will leave in year 20X2 and 440 employees will receive their shares at the end of year 2. At the end of year 2, the company's earnings increased by 18%. Therefore, the shares did not vest. Only 29 employees left. Company believes that additional 23 employees will leave in X3. Earnings will further increase so that the performance target will be achieved in 20X3. So year 2 may the vesting period is increasing to how many years? 2 years or 3 years? It's increasing to 3 years. At the end of year 3, only 21 employees have left. Assume that the company's earnings increase to the desired levels and the performance target is met. Determine the expense for each year and pass the appropriate journal entries. Simple hai. First point, is this a market related condition or non-market related condition?
Non-market, sir.
Non-market. So
Non-market.
because it is a non-market related condition, the impact of this is not an input for the fair valuation. And therefore, we will calculate this at the time of determining how many options have actually vested. So total employees, we start off with 500. At the end of year 1, how many employees left? 29. How many employees expected to leave at the end of year 1? Sir, 31, right? Expects additional 31 employees to leave. So number of employees 440. Shares per employee 100. Fair value of shares at the grant date is 122. At the end of year 1, did you meet the condition? Answer is no. You expect to meet it in year 2, and therefore it will be a vesting period of 2 years, out of which 1 year is already complete. So 26,84,000. Are we okay with this?
Yes, sir.
Perfect. Coming to the next one. Okay. 500 employees minus 58. How do I get this 58? Okay, this 58 is 29 employees already left in year 1, and at the end of 20x2 another 29 left. So totally kitne nikle? 58. Yes or no? 29 plus 29, 58. Are you okay with this?
Yes, sir.
Alternatively, what you can do is 500 minus 29. This comes to how much? 471. Okay. And from here, I can reduce 29. You can do it this way also. No harm. Okay. Answer same ही आएगा. Yes. All right. And number of employees expected to leave 23. So 419. Shares per employee 100. So 122. 2 by 3. I did not meet the condition in year 2 also. See, earnings increased only by 18%. It should have gone more than 20%. So I did not meet the condition. So vesting period has increased from 2 years to 3 years. So I multiply 419 into 100 into 122 into 2 by 3, 34,07,867. Out of this, 26,84,000 is what I have incurred in the first year. So 7,23,867 is the expense for the second year. Are we okay with this? Yes?
Yes, sir.
Perfect. And coming to the last category, expense for 20x3, 500 minus 79. Now, how do I get 79? 29 plus 29 plus 21. Alternatively, what you can do is 471 minus 29. That comes to how much? You can take it as 442 minus
21.
21. You can do it this way also. Answer will be the same. Anything is acceptable. Okay, I'm fine. And number of employees expected to leave, 0 nahi hoga. This is not applicable. 0 bhi likh sakte ho, not applicable. It won't have any implications. So 421, 100, 122, 3 by 3. 34 lakh is what I have already recognized as an expense. So 17 lakh is what I'm going to recognize in the future. Are you able to understand this?
Yes, sir.
Yes. बस तो हो गया. Journal entries are passed for 1, 2, 3. And finally, SBP reserve account debit to equity share capital. 5136,200 is moving to the share capital. Are you able to understand? Yes.
Yes, sir.
So that takes care of 51 we did. 52 also we did. Okay, slide number 52. Perfect. Sure. Let's proceed to the next one. Can you try this for homework? Yes. You can try this question
Yes.
for homework. same impact, but यहाँ पे there is a reversal in 1 year. Reversal is perfectly normal. When there is a reversal, you will give a credit to the employee expense head. Okay. So आप वो दे दो and then you can process the uh, entry accordingly. Okay, so that is why in my question, I have marked the reversal in red. You don't have to panic about it. It's perfectly fine. Year 1, I thought I will meet, so I booked the expense. Year 2, I did not meet, so I reversed it. Year 3, I met the condition, so I recognized the cumulative expense in year 3 itself. Okay, so that is the only nothing special for me to explain. Expected employees at the end of each year is given. Vesting period is 3 years. Go on recognizing the expense. Straightforward calculation, nothing new from my side. Okay. So this is your next one. All right. Perfect. So that takes care of this. Fine. Share price related and the compensation related, we will pursue this in the next class. Okay. All right. So I think we are okay to do this. In the next session, what we will do is market-based conditions, ESOP modifications and cancellations. And finally, we will close with group share-based payments, etc. So new topics here. SBPs with cash alternative and SARs. These are the 2-3 new things which are there. We will see that and close it in the next couple of in the next session. Okay, so I think we are on track almost to close this topic in the next class. Okay, all right. Now I have a question. How ESOP is beneficial to the employee? Well, obviously, because employee getting his own company shares at a reduced price. He does not have to pay the market value. He will pay below the market value. So he will procure it and then he can keep the share and give it and enjoy the capital appreciation. Or he can also alternatively go ahead and sell the shares and book the profit immediately. So in that sense, it's a beneficial for the employees. Okay, all right, fine. What I want you to do is, I want you to go through this theory if you can. Okay, much of what we have discussed, I have already mentioned in the theory. Okay. Basic principles in measurement. You can read this for homework. Homework. Effect of service and performance condition we have seen. Performance condition is not a market condition. A market condition we have seen. All this you should be able to read and understand. Okay. Reload feature, you can keep it on hold. No problem. Yes. That's it. So these theory slides you can go through. It's in line to what we have already discussed. Okay. Much of it we have covered in the questions that we have solved till now. Okay. All right. This now you will be able to understand this slide as well as this slide. Okay. Yep. Perfect. So from my side, we have covered almost half of the topic. Remaining half, we shall look to cover it in the next session. Okay. All right. Fine. Anything else? Anyone, any doubts, queries? Pooja, Monica, Jeannie, Mamta, Karthik?
No, sir.
No queries, no doubts. Okay. So let us meet again on what is the date? Thursday, 14th, and wind up this chapter. Okay. All right. Thanks everyone. These are uploaded, beta. These are uploaded. Yes, the presentation as well as the questions. Okay, you can have a look. It is under the assignment section. Okay, it's under the assignment section. Okay, thanks everyone. See you. See you.
Thank you, sir.
Okay, thank you.
Thank you, sir.
Thank you. Thank you. Yeah, session concluded. Thank you.